What if the economy you live in isn't the real economy? What if inflation, recessions, booms, and crashes aren't natural cycles, but engineered outcomes? And what if the decisions that reshaped your savings, your salary, and your future are made in private rooms you lines never enter, by people you didn't elect, using tools you were never meant to fully understand? Central banks claim to maintain stability, but stability for whom, and at what cost? Today, we peel back the curtain on the institutions that quietly rewrite economic reality, without headlines, without public debate, and often, without accountability. To understand how central banks became powerful enough to influence the entire global economy, we need to go back to a world where money wasn't controlled by committees or economists, but by kings, merchants, and gold. For most of history, money was simple. If you had gold, you were rich. If you didn't, you weren't. But this simplicity came with chaos. Wars drained treasuries, monarchs debased their coins. Merchants hoarded precious metals, local banks collapsed without warning. Economies swung wildly with no safety net, and into this chaos stepped the earliest proto-central banks, not as guardians of stability, but as solutions to government problems. The first major example came in 1694 with the creation of the Bank of England. England needed money for war, lots of it, so private financiers offered loans in exchange for something unprecedented: the right to issue banknotes backed by the government. Over time, these notes became the money itself. The government became dependent on the bank, and the public became dependent on the notes. This wasn't just financial innovation. It was the beginning of a shift in power, from monarchs to money creators, a shift that would echo for centuries. As industrial economies grew, crises became more frequent. Panics in 1819, 1837, 1857, 1873, 1893, every few decades, financial systems crashed under their own weight. So nations built central banks as buffers. Their missions sounded noble: lender of last resort, guardian of currency, stabilizer of credit, keeper of gold reserves. But each added responsibility transferred more control from markets to committees, from individuals to institutions. The most pivotal moment came in 1913 with the creation of the Federal Reserve. Born in secrecy on Jekyll Island, shaped by bankers, supported by politicians desperate to prevent future crises, the Fed was designed to sit above politics while wielding extraordinary influence. With each crisis, central banks gained more power. After the Great Depression, regulation of interest rates. After World War II, influence over global exchange rates. After the 1970s, control of inflation and money supply. After 2008, authority over entire banking systems. After 2020, direct intervention in markets, bonds, and even corporate debt. The pattern was clear: every disaster justified more central bank intervention, and every intervention strengthened their role in shaping economic reality. The most important turning point in modern economic history came in 1971, when President Nixon ended the convertibility of dollars into gold. With that single decision, money detached from physical limits. It was no longer tied to gold, silver, or anything tangible. It became an abstraction, a policy tool, a number on a screen. And because money became abstract, so did reality. Central banks could now create money through quantitative easing, manipulate interest rates to control borrowing, expand their balance sheets infinitely, influence markets instantly with announcements, shelter entire sectors from collapse, build or destroy confidence with a single sentence. Economies no longer moved based on supply and demand. They moved based on expectation, emotion, and the signals emitted by central banks. A new economic world emerged, one where reality could be rewritten at will. Once central banks gained the power to shape money directly, consequences followed. Asset prices inflated beyond logic. Stocks rose when the economy fell. Housing became unaffordable. Wealth flooded upward. Debts expanded uncontrollably. Governments borrowed endlessly because central banks bought the bonds. Corporations borrowed cheaply to buy back their own stock. Consumers borrowed to survive. Markets lost discipline. Risk disappeared. Losses were socialized. Gains were privatized. Crises became opportunities. Every downturn became a chance for central banks to increase their influence. After 2008, they saved banks. After 2020, They saved everything: airlines, companies, stocks, even entire sectors. That was the moment central banking crossed a line. They weren't just referees anymore. They were players, and sometimes, the entire field. Governments couldn't challenge them. Banks depended on them. Corporations aligned their strategies with them, and citizens barely understood them. The institutions meant to protect the economy had quietly become its architects. Politicians often criticize central banks, but here's the truth: governments need them. Without central banks, interest rates would skyrocket, debt markets would collapse, currencies would freefall, banks would fail within days, financial crises would be uncontrollable, and so the relationship deepened. Governments spend, central banks buy the debt. Markets react, central banks calm them. The cycle continues. Attempts to normalize policy always fail because the system is now addicted to artificial stability. Higher rates collapse housing markets. Lower rates fuel bubbles, reduced money printing triggers recessions, increased printing triggers inflation. Every remedy creates a new instability. Every instability justifies a new intervention. The machine can no longer be turned off. Today, the fingerprints of central banks are everywhere. Global central bank balance sheets exceed $30 trillion. Stock markets move more from Fed speeches than earnings. Governments fund entire budgets through low-rate borrowing. Inflation waves destabilize nations while policy committees debate behind closed doors. Real estate prices move based on rate announcements, not supply. Bond markets act as extensions of central bank policy. Here's the most shocking pattern. Every major economy, the US, EU, China, Japan, is now engineered from the top down. We live in a world where money is a decision, inflation is a policy, growth is a target, and stability is manufactured. Economic reality is no longer discovered, it's constructed. Takeaway 1. Central banks have evolved from stabilizers into architects, shaping economic reality through decisions more powerful than elected governments. Takeaway 2. Once money detached from physical limits in 1971, central banks gained the ability to manipulate economies with unprecedented tools, creating cycles of dependency. Takeaway 3. The global financial system is now structured around central bank intervention, making withdrawal impossible without triggering catastrophic instability. If the power to shape economies rests in the hands of institutions nobody votes for, then the question isn't whether central banks are doing the right thing. The question is, who decides what right even means? As long as economic reality can be rewritten behind closed doors, the public only sees the final result, never the mechanism. And by the time we do see it, it may already be too late to change. If you want more deep dives into the forces shaping our financial world from the shadows, make sure to like this video, subscribe, and hit the notification bell. This story isn't over, and what comes next may be even more important.